The risk in the market is increasing even as I see the possibility for the market to continue to go up. And that is not contradictory at all. I mean, you can have a lot of risk that doesn't what's the expression? What would I say? Doesn't come to fruition. And I'll never forget my friend Bill Barner, gave a wonderful analogy of the guy that's at the party, gets absolutely stone drunk. It's 1 o'clock in the morning. He gets into a car. He speeds home at 80 miles an hour on 30-mile-an-hour speed limit streets, and finally stumbles into bed. Well, the fact that he arrived in bed safely does not mean there was not any risk. And it's the same that I see with the stock market right now. So number one, it is overvalued on any fundamental basis, and I don't know how anyone can dispute that. Number two, the breadth has become even more narrow than it was. At the end of last year, it was an all-time record, the narrow breadth, meaning there's only a handful of stocks that lead in the market, and it's got even narrower over the last 10 months. So the breadth is really narrow. There's a lot of different indicators that market technicians use, the Hindenburg omens or whatever, and so on. And I'm not going to get into all of those, but all of these indicators are flashing red. And perhaps the most important one would be this ratio of insider sales to purchases. Now, there's a lot of reasons that insiders might want to sell, a lot of reasons. There's only one reason that you buy in the market, unless you're trying to pump up your stock price. There's only one reason you buy in the market, and that is that you like it. And when the ratio of insider sales to buys is so overwhelmingly on the sell side, a multi-decade high, all of those four are indicators that the market is stretched and the next major move will be down. But none of what I've said will tell you when it's going to happen. Certainly doesn't tell you it's going to happen tomorrow morning. But from an investment point of view, I think what it does tell you is that there is increasing risk in the market. And so we're just being very, very cautious with what we buy. We're buying defensive stocks, which will tend to go down less than...
Adrian begins by explaining that the sudden drop in gold and silver prices isn't something unusual or alarming. It's part of a normal correction that occurs during every major bull market. He reminds viewers that these metals had already risen sharply over the past several months, so a temporary 25 to 30% decline is simply the market catching its breath before moving higher again. According to him, investors often get worried when they see quick price drops, but if they look at history, they'll notice that similar pullbacks happened many times before. For example, in 2009, 2011, and 2012. Yet each of those periods was followed by even stronger rallies. This shows that short-term corrections are natural, even healthy, because they allow the market to stabilize before continuing its upward trend. He then shifts focus to the fundamental picture, emphasizing that nothing significant has changed to weaken gold or silver's long-term outlook. Inflation remains persistent, global debt levels are skyrocketing, and confidence in fiat currencies like the US dollar continues to decline. Adrian points out that central banks around the world are buying gold in record amounts, particularly those in emerging markets such as China and India, which are trying to reduce their reliance on the US dollar for trade and reserves. This accumulation of gold by central banks, along with strong consumer demand for physical metals, proves that the global financial system is gradually losing trust in paper currencies. He suggests that these underlying factors are far more important than daily price swings and that they continue to support higher prices for both gold and silver in the long run. Finally, Adrian delivers a message of patience and perspective to investors. He advises against panicking or trying to time the market perfectly. as short-term fluctuations often scare inexperienced traders into selling too soon. He shares examples from past decades where people sold gold and silver during corrections, only to miss out on massive gains later when prices surged again. His main point is that those who hold steady and focus on fundamentals, rather than fear-driven price action, are usually the ones who benefit the most when the bull market resumes. Essentially, Adrian wants investors to stay calm, trust the larger economic trends, and remember that gold and silver's true value lies in there to preserve wealth over time, especially during periods of monetary instability and global uncertainty. Subscribe to Fine Metals for future update related to market trends. Thank you for watching.
And I'll just say, for example, central banks, which have obviously been the most important buyer for the last 3 years, particularly particularly 23, 24, and the beginning of this year, they've been almost holding gold up alone. If you look at the central banks, they're diversifying away from concentration in a single asset, an asset of a country that is fiscally irresponsible, and added to that, a country that is using its dominance, it's weaponizing its dominance, both with the dollar and with the SWIFT system. And this has been going on a while, and that's the point that I would want to estimate, both the weaponization of the dollar and also the central bank's diversification away from the dollar has been going on for a while. If you go back to 1999, the beginning of this century, in aggregate, central banks had 78% of their foreign reserves in the dollar. 78%. And by foreign reserves, we mean for the Bank of England, not the British pound, for the Bank of Japan, not the yen. So foreign reserves, 78% were in the dollar. 5 years ago, that was down to about 65%. Last year, according to the IMF, it ended the year at 58%. And in August, the ECB said it was 48%. And so this has been going on a long time. And what I would say is that the drivers, nothing has changed. I'm not going to get political, but I would say even if this administration didn't start the onslaught, they've done nothing to change it or to stop it. And if you're a central bank worried about concentration of a single asset from a fiscally irresponsible government which might weaponize its dominance, well, I ask the question, is 48% still too much? And I would say 48% is still too much. So we're going to get continued reduction in the dollar. And remember, these countries are continuing to earn dollars all the time. So we're going to get continued reduction in the percent in the dollar. And where is that going to go? Some will go to the euro. The euro is at about 22% of central bank's foreign reserves. For the aggressive ones, some will go to the yen, or some might go even to the Australian dollar or something. But this is at the margin. Most of those assets, other than the euro, most of those assets are going to go to gold. And that's going to be things. One is the fundamentals are still there. The second thing is that the reasons people would, as I just said, the reasons people have been buying gold still remain intact. That certainly hasn't changed. And the third thing I would say is that there is no mania. Absolutely. The last 2 days, we've had absolutely very sharp declines. But if we look at it in context, I'll say a few things. First of all, you said we're only back to where we were less than 2 weeks ago, less than 2 weeks. Second point I would make is that even this dramatic decline for the last 2 days, as dramatic as it is less than 20%, no, less than 30% of the rally from September. So, and given that rally, as you said, was so extraordinarily sharp, when you have a pullback, you expect a pullback, frankly, of as much as 50 or even 60% of the rally as a retracement. So we haven't seen that yet. And if you look back, whether it's 2020, with COVID, or 2011, obviously, 2011, 2009, 2006. We've had declines similar to this in the past. This is not, I've heard people say unprecedented. This is not unprecedented at all. And the point I'm making is that there is no broad public participation in this market. And you cannot have a top. It's impossible to have a top in a market, by definition almost, without public participation. 1980, you certainly had public participation. You will remember, even though you weren't alive, you've seen the pictures, I'm sure, of people lining up at coin dealers, lining up around the block to buy gold. We haven't had that this time. So no mania, very, very little in the way of public participation. And so I just, for those reasons, I just don't think it's a top. Some of the coin dealers I talk to will tell me that up until the last week, even if they've been busy, it's been as many people calling to sell gold and silver as it is to buy gold and silver. When you look at most mutual funds, and I'm not talking about our mutual fund now, and, we're not allowed to give out information before it's been publicly released. I'm not talking about ours. But I can tell you that most gold mutual funds, and I'm talking now obviously about equities, but most gold mutual funds have been seeing ongoing outflows. For GDX, which is the minor ETF, if you look at the last month, it's had a small inflow, net inflow. But, for the last 2 months, 3 months, 4 months, it's been outflows. Silver is just still remarkably undervalued. It's only just hit its nominal high, right? Let alone its inflation-adjusted high. So, yeah, I would agree. The gold is still undervalued and silver is even more undervalued. On, the price of gold today, inflation adjusted compared with previous highs, that's one metric, but I don't think it's a be all and end all. Apart from anything else, the CPI is a very, very unsatisfactory metric to use. Now, if we went back to 1980 and used the methodology that they were using back in 1980 and used that the whole way through, well, you'd find gold is still not particularly expensive. It's more or less the same. It's more or less just kept pace with inflation over that period. You can look at gold versus the money supply, U.S. money supply, global money supply, U.S. versus debt. Gold versus debt. All of these are sort of metrics you can use that give you a gauge. No one is perfect. As with a widget manufacturer, you can say, well, I'm looking at the price to earnings, right? But you can't do that with gold. But all of these metrics, and then other people will look, and one of my favorites, frankly, is the gold to Dow. So gold versus financial assets. Most of the big shale fields have now peaked, and the remaining ones will probably peak, if not this year, next year. So we're not going to continue to see growth from the shales. Now, how long are those tails? I won't go into it because I'm not a whatever they call them, geophysicist or something. I won't go into all the details. There are reasons to think that the tails on shale are a lot shorter than the tails on traditional fields. Think back to the poor people in 1974 when gold dropped literally 50% in less than a month. And those who sold at that point, of course, missed the move from $100 to $850. So, yeah. So, I think that the lesson always is not to overinvest in any one sector. If you don't overinvest in a sector, then you can tolerate these times of what are euphemistically called volatility, but really is declines, right? Have you noticed how every time something declines, people just say, oh, there's a lot of volatility in the market today? you can tolerate that. It's only when you're over invested and overstretched that these things start to be a concern. So I think I would just hold on, and in the equities I would begin to pick away, look for some good opportunities.